Welcome back to the Neuro Finance Masterclass. Today, we're diving into something that is absolutely critical for anyone involved in digital assets, what it really means to own your crypto. And trust me, this isn't just some abstract theory. This is about the very foundation of securing your wealth.
So let me just ask you this, straight up. That crypto balance you see sitting in your exchange account, do you think it's actually yours? Really, think about it. The answer might just shock you. And honestly, understanding it is the key to protecting everything you've built.
All right, let's get right into it. The first, and maybe the most dangerous misunderstanding in all of crypto is this illusion of ownership. Millions and millions of people see that number on their screen and believe, without a doubt, that it's their property.
This slide right here shows the huge gap between what you think you have and what you actually have. You see a balance, sure, but what you're really holding is a digital IOU. It's just a promise from a company that says, yeah, we owe you this. It is not the asset itself.
And let's be crystal clear about this. The idea that you own the crypto on an exchange, it is mathematically and legally false. This isn't just a small detail or some technicality. It's a fundamental truth that every single serious investor has to come to terms with.
So, that brings us to the most important principle in the entire crypto universe. Seriously, this is the one rule you have to burn into your brain if you want to protect yourself.
And here it is. It's the oldest, most brutal, and most honest rule in crypto. Not your keys, not your coins. Say it with me. This phrase should be your mantra. It is a non-negotiable absolute truth.
So, what are these keys we're talking about? Well, a private key is basically this unique string of letters and numbers that proves you own your crypto and gives you the power to spend it. The best way to think about it, it's the only physical key to your digital safety deposit box.
So here's the kicker. When you leave your assets on an exchange, you are literally handing over the key to your vault. The exchange holds your private keys, which means, by the unchangeable laws of the blockchain, it's their money, not yours. You've given up all your control.
Now, you might be thinking, okay, so what? Why is giving up that control so incredibly dangerous? Well, let's take a look at the harsh realities of this space.
You have to get this straight. You have to understand this critical difference. Crypto exchanges are basically just tech companies. They are not traditional, heavily regulated banks. All those protections you just assume you have in the banking world, they don't exist here.
When you give up your keys, you open yourself up to massive risks. We're talking about catastrophic hacks that drain everything. We're talking about insider fraud. We're talking about a company just going bankrupt overnight. And here's the scariest part. Unlike a bank, there's absolutely zero government-backed insurance to bail you out. When it's gone, it's gone.
And hey, this isn't just some scary story. This actually happened. Remember the FTX collapse? Over $8 billion in customer funds? Just gone. Poof. Vanished. People who thought they were crypto millionaires one day woke up the next with absolutely nothing.
And here's the grim legal truth of it all. When an exchange like that goes down, you don't just get your money back. No way. You become what's called an unsecured creditor. That means you're just another person in a very, very long line begging a bankruptcy court to maybe, just maybe, get a few pennies back for every dollar you lost years down the road.
So how do you avoid this nightmare scenario? How does a professional, someone who is an architect of their own financial future, avoid this? Simple. They build their own vault. They take absolute control.
The solution is something called cold storage, which usually comes in the form of a hardware wallet. It's this little physical device, kind of like a USB stick, and its only job is to create and store your private keys completely offline. And because it's offline, it's pretty much immune to online hackers.
This, right here, is the ultimate power move. When you move your crypto from an exchange to your own cold wallet, you are firing the middleman. You're taking your keys back. You, my friend, become your own bank.
And that is the power of true ownership. It's what we call financial sovereignty. Think about it. No government can freeze your funds. No crooked CEO can gamble away your assets. No hacker across the world can steal your keys. You are in complete, total control.
Okay, but all this knowledge is totally useless if you don't do something with it. So, let's turn this lesson into your own personal action plan for achieving that financial sovereignty.
Here is your task for today. Step 1. Audit your security right now. Where are your assets? Step 2. Be honest with yourself and acknowledge the insane risk you're taking if they're sitting on an exchange. Step 3. Do some research on reputable hardware wallets. Brands like Ledger and Trezor are the gold standard.
And finally, step 4, take action. Secure your assets.
And if you're worried about the cost, think of it this way. The $100 or so you might spend on a hardware wallet isn't an expense. It is the cheapest and most powerful insurance policy you will ever buy for your financial freedom. The peace of mind and total control you get in return, priceless.
So I'm going to leave you with one final question to really think about. After all of this, which one are you right now? Are you an investor who truly owns their asset, or are you just a creditor who owns a promise from somebody else? The choice ultimately is yours. Make the right one.